On the 24th of March 2020, India's Sensex hit its 52-week low at 25,638 points, which was a drastic drop of 40% from its all-time high in Jan the same year. On one hand, India had crossed the 1.4 million mark of the rising COVID cases, due to which the government had imposed a nationwide lockdown, and on the other hand, the stock markets were incessantly growing. The government's $266 billion pandemic relief package has not instilled much confidence in credit rating agencies, and Moody's has even downgraded the country to the lowest investment grade, which is just one step above junk status. Yet, amidst all the chaos, Sensex and Nifty have climbed more than 45% since March. Now this brings up the question, has the economy started to recover already, or is it history just repeating itself? Your whole life you would have heard that timing is everything. You would have also heard people say that be in the right place at the right time. It has always been considered great to invest in real estate and hold it over time, unless it was back in the late 2007. And tech stocks have been great unless you bought them right before the dot-com crash. Basically, the point here is that there is a right time and a wrong time to buy almost any asset out there. The investing masses are known for buying assets at the worst time and for shying away during the best times to be a buyer. Why? Because they buy in the wrong phase of the market. The subprimal housing loan crisis of 2008 brought the global economy to a standstill. The dot-com bubble of 2000 destroyed the IT industry. And well, the Great Depression of 1929 depressed everyone. Now if we observe the market charts of these years, we find a very similar pattern, and that's exactly what is happening in 2020 as well. Now every market cycle has 4 phases, which are the stealth phase, awareness phase, mania phase, and the blow-off phase. We are going to discuss these phases at length and compare the current scenario with the past and understand its implications. So starting off with the stealth phase, as you can see in the graph, it is a phase where smart money pours into the market, taking advantage of undervalued assets and equities. Those who understand the new fundamentals realize an emerging opportunity for substantial future appreciation, but at a very high risk since their assumptions are so far unproven. So the smart money gets invested in the asset class, often quietly and cautiously. The investors who lie in this category tend to have better access to information and a higher capacity to understand the wider economic context that would trigger asset inflation. And because of this, prices increase gradually, but are often unnoticed by the general population. It is said that the stealth phase is the best time to get into the markets because during this phase, investors beat many of the hedge funds and pension funds into the stocks, and when they come on board, they push your stock up a lot. And they are like the tidal waves of money that you want to be in front of and not behind. Post the stealth phase, these stocks move into the awareness phase. This is when early recovery is more evident and institutional investors begin to hop on board. As an investor, you need to be extremely patient while investing in the stealth phase and the awareness phase because at this point of time, most of the stocks are not running at their full potential. But a very interesting point here is that when one compares his upside rewards to the downside risks in these phases, they stand at a very favorable position and end up reaping a dividend yield that most investors could only dream of. However, there can be a short-lived sell-off phase taking place as a few investors cash in their first profits. The stealth investors take this opportunity to reinforce their existing positions, and in the later stages of this phase, the media starts to notice with the positive reports about how this new boom benefits the economy by creating wealth. Now this is where things get really interesting. Everyone begins to notice that the prices are going up and retail investors like you and I get into the market for this so-called investment opportunity of a lifetime. The expectations about the future appreciation become a no-brainer, which of course goes against any conventional wisdom. This phase, however, is not about logic but a lot about psychology. Tons of money flows into the market that creates even greater expectations. What does it result in? Yup, you guessed it right. The prices are pushed through the stratosphere. The higher the prices go, the more the investment pours in. This again goes fairly unnoticed from the general public who are caught in this new frenzy. The smart money, as well as many institutional investors, quietly start selling their positions. Often new entrants have absolutely no understanding of the market dynamics and the fundamental structure, and yet invest in the markets thinking it would be an easy source of income for them. Prices are simply bid up with all financial means possible, particularly with the help of leverage and debt. And if the cycle is linked with a careless source of credit, it will endure far longer than many observers would expect, and this would result in economists terming the situation unstable and calling it a financial bubble. However, even after a major correction in the prices, the markets start to shoot up, and everyone believes that this is the new normal. Not many realize it, but the worst is yet to come. The whole phase is known to be a bull trap, and suddenly, within days, prices start to plummet. Amidst all of this chaos, statements are made about the new fundamentals, which implies that a permanent high plateau of the prices has been reached, and in order to justify the same, the future prices start to increase. And this is the exact point when people realize about the bubble and the panic sets in. The beginning is the end, and the end is the beginning. A moment of realization arrives, and everyone now knows that the situation is not the same as they expected it to be. Confidence and expectation encounter a paradigm shift, along with a phase of denial where many news channels and influencers try to reassure the public that this is just a temporary setback. Some are fooled, but not for long. Many try to unload their positions, but there is no one to buy into their positions. The house of cards collapses under its own weight, and the latecomers, commonly the general public, are left holding depreciating assets and declining market prices, while the smart money investors have pulled out a long time ago. The equity prices fall at a rate which is much faster than the one that inflated the bubble. Many over-leveraged asset owners go bankrupt, triggering additional waves of sales. On one hand, the general public terms this to be the worst possible investment period, while on the other, the smart money investors start acquiring assets and equities at dirt cheap prices. And this is where the cycle gets completed. So just to sum all of it up, there are 4 phases that a market goes through. The stealth phase, where the smart money pours into the market taking advantage of undervalued assets and equities. The awareness phase, where the early recovery is more evident and the institutional investors begin to hop on board. The mania phase, where the enthusiasm and greed takes over and the market moves higher in a parabolic price model and ultimately reaches a massive top. And the blow-off phase, where the bubble bursts and panic sets in. The stock market cycle takes years to build. It does not happen over a week or a month's time. It is an accumulation of price rallies and corrections over 8 to 9 years. If you see both NSE and BSE charts from 2002 onwards, you will see that up until 2008, there have been multiple accumulations of price rallies and some major corrections in the year 2004 and 2006 due to the stealth and awareness phase. But when the markets entered the mania phase, within just 1.5 years, NSE went from 2,491 points to 6,326 points. Now why did this happen? Well, this was the mania phase, and it is driven by psychology and not logic. Eventually the markets entered the blow-off phase, and on the 21st of Jan 2008, NSE and BSE hit rock bottom and many investors lost a major chunk of their capital. Since 2012, the NSE and BSE have followed the exact same pattern yet again. There were many price rallies and had a major correction in the year 2015, and from 2018 onwards, the markets began to shoot up incessantly, regardless of the economic condition of the country. But then came a major economic correction in the month of March, because of which the stock markets dropped by 40% within 2 months and again rose up by 45%. Now what's scary is that the 45% hike seems to be short-lived and the smart money is already out of the markets. Comparing it to the US markets, billionaire Warren Buffett has been sitting on $128 billion and appears to be waiting for a bigger crash so that he can buy the dip. There are primarily 2 reasons why the markets are shooting up right now. One being that in the last 3 to 4 months, retail activity has picked up significantly, not just in India, but a lot of other markets across the world. People have been working from their homes, so they have more time on their hands to think about their finances, and along with that, interest rates around the world have crashed. The money in the bank is not yielding as much, so people are looking for alternatives. It's as if everyone wants to enter the stock markets and are playing around with large sums of money. Many companies listed on the stock exchanges are out of business due to the pandemic and are barely making any money, and yet their stock prices are rallying every single day. Why? Simply because the new entrants are investing in these companies with very less knowledge. Prices are simply bid up with all financial means possible, be it with the help of leverage or debt. According to Nitin Kamath, the CEO of India's leading stock brokerage firm Zerodha, we were adding 70,000 to 1 lakh new customers before COVID-19. The month of March was the biggest month for us when we added about 3 lakh accounts. Now we are averaging between 1.5 to 2 lakh new customers a month. Trading volumes not just for us but for the exchange and for other brokers are up at least 40 to 50%. Since this period has seen so much volatility, trading volumes are up because of that as well. Looking at this, it is pretty obvious that if the trading volumes are high, prices have to be high. But at what cost? The US markets are right now in a place where investors are buying anything and everything. The US is probably at its peak of the bull market. The Fed is continuously pumping in trillions of dollars in the economy, and it's madness all around. The US government is transferring the money directly into their citizens' account, and this money comes back into the stock market in the form of an investment. However, this is a huge problem for the rest of the world because the US is the mother of all markets. If something happens there, everyone will get affected, and there are high chances that the US markets crash close to the presidential elections in November. The second reason why the Indian stock markets are going up is because many small cap and mid cap companies are under a period of moratorium. Moratorium can be defined as the deferment of the payback of loans. The moratorium period is supposed to end on the 31st of August, and post that, when companies have to start repaying their loans, the scenario might get ugly. Reason being, companies don't even have enough money to operate. Paying back their loans seems to be a different story altogether. And if these companies do not pay back their loans, it will take a heavy toll on the banking and the financial sector of the economy. The HDFC chairman Deepak Parekh even asked the RBI governor not to extend the moratorium period further because extending the moratorium will hurt non-banking finance companies, as many customers who have the ability to repay are deferring their payments. The RBI in its financial stability report had projected non-performing assets to rise to a 20-year high to 12.5% of the total advances made by March 2021. In fact, after 6 consecutive weeks of gains in the markets, the bears have finally made a comeback. Going ahead, the markets may see further consolidation with negative bias, and most of the positive news has already been discounted. With major corporate earnings out of the way, the street will now focus on the RBI policy, which could set the path for the banking sector as the moratorium period comes to an end. The gold prices are at an all-time high, and time and again we have seen gold act as a hedge for investors in times of uncertainty. As Keynes said in the 1930s, the markets can stay irrational longer than you can stay solvent. So investors are advised not to act foolish and play their cards smartly. It is always better to remain cautious and accumulate quality stocks in this pandemic, because both you and I know that though it is very tempting, trying to time the market is a loser's game, so you be an intelligent investor.